Now, the Reserve Bank of India has raised the risk weight on consumer loans by 25 percentage points to 125% for banks and NBFCs, barring loans like home, auto, education and gold-backed loans. In addition, it has also increased the risk weights on credit card receivables and unexpectedly on bank loan to NBFCs as well. Now, for NBFCs and fintechs, this may prove to be a double whammy. Not only will they have to set aside higher capital, their cost of borrowing from banks could also go up. Joining me now to discuss the implications of these new rules are Ranveer Singh, the co-founder and CEO of Kisht, and Kunal Verma, the co-founder and CEO at Freo. Ranveer, Kunal, both of you, thank you very much for your time here. Ranveer, if I could start by asking you, where does this concern stem from? The RBI governor has been cautioning lenders about this huge spurt in, unsecured lending, but is there any data to back that, there are higher delinquencies?
Oh, absolutely. First of all, I think RBI needs to be complimented for coming up with this measure. Needless to say, scrupulously researched and well ahead of its time. I think there are two things to be said for why RBI is coming up with a measure like this. First of all, anybody who has seen unsecured lending in the last, I would say 12 to 18 months, it has been so evident that it doesn't require any evidence that there is a fraction of customers, though a very, very small fraction of customers, where one is seeing an element of over-leverage building up. The number of loans taken by customers has increased for a small proportion, not for a large part. And, coming from this, when we are catering to 10 million customers, you tend to, trust your gut. And I think RBI has come very, very timely to ensure that there is far more responsible lending going into this space. We did a similar thing around 12 months back when we started cutting lines of people wherever we saw slightly higher, the first inkling of risk being high. So despite the customers paying right on time, we basically cut the line. But anyway, that's first part. I think the second thing to be said here is, see, RBI in the past also has shown an unshakable resolve in thinking well ahead of its time in ensuring the stability in the market. And this is one of the measures to ensure that before anything blows up out of the proportion, it has to be nipped in the bud. So it's basically coming from that, which I would say go a long way in providing more stability and ensuring something untoward can be avoided in future.
Kunal, if you could also come in, what is the delinquency that you are seeing on these unsecured lending? And plus, you're one of those lenders that does lending in partnerships with other banks and NBFCs, not largely through your own balance sheet. Now, what is the impact going to be second round or first round when it comes to your business volumes, your margins, and, the outlook as far as, the repercussions from that rule is concerned?
Sure, Ritu. So I think the first point, Ritu, is are we seeing increase in delinquencies? I think in our portfolio, we specifically for the smaller ticket sizes and unsecured lending, we've actually seen the trend moving towards much better performance in the past 12 months. This is because of very strict credit discipline. So I think it's a mixed bag. A lot of players might be seeing increasing delinquencies. We've actually been seeing the reverse. We've actually been seeing the performance becoming better and better, but that's probably because of company internal policies. The second point in terms of what it does, see, Freo, it does a lot of co-lending, work with balance sheet partners of banks and NBFCs. We do think that every large balance sheet player today is evaluating the impact on its capital adequacy as well as its potential impact on return on equity. Now, people who are sitting on very, very large balance sheets probably already have enough capital put aside to compensate for the additional 25 basis points of provisioning equivalent required. But people who are sitting on mid-sized balance sheets or sitting on smaller balance sheets and have a large exposure to small ticket lending wherein the performance is not good, they will probably have to put more cash aside or through the securitization model expect their partners to put up more cash, which I think in turn will see some cost structures getting impacted in the short term. But these will primarily be for players where the portfolio performance is not so good. I don't see any change in demand from the consumers. Maybe in the credit card side, there might be tightening on the portfolio by the credit card issuers, which are mainly banks. But consumer demand, I don't see an impact. People who have very good portfolios don't see them passing on the cost to borrowers. But people with bad portfolios or a balance sheet focus, but not able to scale up too much on the balance sheet, they will probably see an impact on their margins.
Sure. Well, Ranbir, while you also, at Kish, have co-lending partnerships, you also have your own NBFC. So tell us from both points of view, what happens both on the lending side and on the borrowing side? By how much do costs go up? By how much is your capital adequacy going to be impacted? And, what has been the conversation with lenders? Do you think, as banks and as NBFCs reassess their capital buffers, there will be some slowdown, at least in the near term?
Oh, absolutely. There would be some reassessment of what is the capital adequacy numbers that one would go with the enhanced risk weight. Our own calculation is with the partners that we work with, it is not going to impact much. And this again boils down to, are you a small player or are you working with people who are already very large player and are responsible lenders? In fact, my own sense is it is only going to reduce the capital adequacy or the risk weight, the capital adequacy most of these banks have by perhaps 25-30 basis points, which is not significant. And my sense is I honestly think and sincerely hope that this will not impact any pricing on the consumer loan side. Now, of course, we have the unique distinction of working both models, which is we lend from our own NBFC, plus we also have off-book model where we use other people's balance sheet. Now, the other thing to be said here is people who are providing off-balance sheet, who are on the other side, they have been very experienced players. They are not, coming in a manner where they are showing some spontaneous enthusiasm all of a sudden. And these people have seen our repayment track record. They have seen how the risk has been very, very well managed. In fact, if anything, it has only come down. And at least for us, we don't see any impact, be it on pricing or for that matter, on the liquidity side, just because the risk weights have increased. If anything, I do see one impact where banks will have a tendency to go after doing loans more with companies who are perhaps rated AA or AAA rated odd or so. But, and one would see a higher share of credit flowing into that portion as against, the ones who are rated lesser NBFC. But I believe it is not only true for us, but true for any large credible player. The partnership is only with large NBFCs who actually are already rated very well and very well capitalized. So I don't see much impact, at least in the near term. Of course, it will have a long-term impact, but that adjustment will happen based on banks looking at different portfolio and then taking a call based on that.
Sure. Okay, so the takeaway from both of you is no immediate hit on demand. And of course, there might be some considerations on the cost side. Unfortunately, we've run out of time. We'd like to continue this conversation later. Kunal and Ranbir, thank you very much for your time here at CNBC TV.
Thanks.
Thank you.
Thanks for that, Ritu. But news just coming in, cab aggregator Ola Cabs